Why I don't want you to underestimate the severity of the next recession. I can always predict there's going to be a recession. I'll be 100% right. When and how much is the problem. This is David Reyes, your retirement architect, here every weekend with you. Thanks for listening. Today I want to talk about a couple things, but more importantly, I kind of want to reset where we're at with the markets, in my humble opinion. And we have the old saying that history doesn't repeat itself, it rhymes. And I like that. I think it's a Mark Twain quote that I use a lot. So if you heard it, I apologize, but it just makes sense. Markets are like that. There's history of markets, and they do rhyme. They all look a little different, but really they look the same. So I was reading something regarding, let me find it, regarding the probability of recessions is getting higher and higher. In fact, there's an index. There's a I guess it's an index that we use that Goldman Sachs uses, the Fed uses, and basically what it's saying is that we have the highest probability, about 27%, which doesn't sound like a high number, over the next 12 to 18 months that we're going to have recession. And it's the highest it's been. Here it goes. According to the New York Fed, very accurate yield curve-based probability model, there's a 27% probability of recession in the next 12 months. The last time this happened was, guess when? It was early 2007, right before the financial crisis. Now, we never know what's going to happen. I can't tell you we're going to have another financial crisis. The point is that there's a lot of things going on under the surface that, and I'll talk about a few of them today, that should cause you concern. And when I say concern, it's not, run and go sell everything. It's that you got to have a plan. I always call it participate and protect. We want to have a plan where we can actually make money. We're not talking about putting the money in the mattress, but we have to always have protection. I would use the analogy of car insurance. If it's a sunny day and you don't have car insurance because it's not raining, you still can get a wreck, right? And only buying insurance when it's cloudy and thunderstorms and lightning, yeah, you probably need more insurance. The problem is that your biggest investment is usually your IRA, 401k, that you don't protect, you don't insure. It's crazy. The average one of you listening probably has about a 30% loss in your portfolio in the next bear market, the next downturn, the next recession, or about $300,000 per million. I met with a gal last week, sweet gal, and she's single. She's about $1 million in her portfolio. She wants to retire next year. And I did a little risk analysis for her, and she has about a 45% max loss if we have another recession. And this is all her money. She'd lose $450,000. And that's no joke. And she had no idea. So we made a huge adjustment to her portfolio, obviously, and got that number way down to about 11% max loss. But bottom line is goals-based investing. She's going to have all the money she needs. I always say I'm a manager of risk. I'm a risk manager, not a manager of portfolio. We manage risk. And if you focus on managing risk, you're not going to get blown up. So some of the things I'm concerned about that are just recent, that this week, is that we're only about 2% from all-time highs, which to me is just absolutely ridiculous. I mean, we're hanging on by a thread, levitating, whatever you want to use. It's not healthy right now. I'm surprised the markets are where they're at today. There's so many things happening. I'll talk about a few, but new home sales actually fell 7.8% in May, even though mortgage rates have been dropping significantly. I think an average 30-year rate mortgage is in the low threes right now. 15-year loans, I think, getting in the twos. So what does that tell you? It tells you that the demand is so weak, even though rates are the lowest they've been in a long time. In fact, the 10-year Treasury just breached 2%. The last time it did that was about 3 years ago. And so rates are at rock bottom. You have new home sales falling. You have consumer confidence, which fell for the worst at the lowest level in 2 years. And consumer confidence has been very high, and it's a big driver of stock markets. So, and another big issue that's coming up right now, whether you follow this stuff or not, is the Federal Reserve. So what's happened, and these are all things that affect markets. When the Federal Reserve, raises rates, usually the economy slows down. What the Federal Reserve has said is that they're going to put rates on hold. Well, Mr. Powell, who's the head of the Federal Reserve, said today, which really shook markets, that instead of a 50 basis point cut, which he thinks will be too much, they're going to do a 0.25% basis, 25 basis percent cut. Well, it's the first time they said they're going to cut. The market already knew it. I think there was a 100% chance in the July meeting that there was going to have, on a probability basis, there's going to be a rate cut. And unfortunately, people think rate cuts are good for the market. They're not. When the Federal Reserve says we're going to reduce rates, what does that mean? Does that mean the economy is healthy and everything is great? No. Why do you think bonds have actually outperformed the stock market in the last 18 months? Think about that. If you just own little old 20-year treasury bonds, which we hold in our portfolios right now, you beat the S&P 500 by about 2 points, 2%. And you've had a lot less anxiety with the market going down 10%, down 20%, up 15%, this massive roller coaster ride, and gone nowhere since January of 18. So this is not a healthy market. And it's hard to wrap your brain around because most of you just, hey, we're at all-time highs, everything's fine, we've had a great year. Yeah, market's up about 15%, but again, you've gone nowhere and had a lot of volatility for 18 months. So, I'm just concerned, and I'm more concerned for you because I see the portfolios that I review every day, and you have way too much risk. You just do. You want to start reallocating your assets today, not when the market goes down 10, 20%. The biggest problem I see is people are not proactive. You're not proactive about your portfolios. Everything's doing great. Well, that's when you want to protect capital. I don't want you coming to see me when you've lost 10, 15, 20%. And it happens. In the fourth quarter of 2018, I don't know how much money we moved, a lot of money. I mean, I had people crying on the phone because they were moving their money. It was in transit between their old brokerage firm and ours because they wanted to hire us because we wanted to protect their capital. And I had clients losing hundreds of thousands of dollars, and there was nothing we could do about it because it hadn't hit our account at Schwab yet. I don't want to see you in that same position. I want you to be in a position of strength. Right now, you're in a position of strength. Markets are still high. It's not going to be that way too long. It's just not going to happen. If you want to get a second opinion from me, you want me to review what you have, I do it every day. I love to do it. I'll review your risk. I'll quantify what your risk is, not what you think it is. I'll actually do a fee assessment for you and reduce the fees you pay, most likely, on your investments. I will do a complete retirement income plan for you, complimentary. I don't charge you for it. Whether you hire us or not, you can have it. So if you want to reach out to me and take advantage of this, I guarantee you will learn things you didn't know. Give me a call, 1-800-611-1967. That's 1-800-611-1967, or go to reyesplan.com. That's REYES plan.com. So there's an interesting quote that I got. I can't take credit for it, but it's kind of cool. And it's a fact. It's this fun historic fact. Every single time the Federal Reserve cuts rates, when unemployment was below 4%, I think our unemployment right now is like 3.4%. Every single time the Fed has cut rates, when unemployment was below 4%, a recession immediately ensued, and unemployment shot up to 6 to 7%. I'm going to say it one more time. Every single time the Fed has cut interest rates, which they're going to do right now, they've already said they're going to do it. Cat's out of the bag. Not that we didn't know they're going to do it anyway. That means the economy is not healthy. They don't cut interest rates when everything's great. Okay? So the Fed has got themselves in a box. They should have raised rates a long time ago. We should have more leeway to reduce rates. We don't. So when the Federal Reserve cuts rates, when unemployment is below 4%, a recession immediately ensues. Immediately. We're there right this second, right now, today. So don't mess around. I'm concerned for you. Again, I see you every day. You all have the same portfolio. You think you're conservative, and you're not. You have a, quote, balanced portfolio, diversified, balanced portfolio. Those are buzzwords. They don't mean one thing. And, in fact, I'm going to be writing a book called Diversification. That's going to be my next book. The current book that's in production right now, actually being copied, hopefully, being printed, is called Mama's Secret Recipe for Successful Retirement, written with Jack Canfield, the writer of all the great books of Chicken Soup of the Soul. I think he's the number one author in the world, actually. So my next book is going to be called Diversification. Everything you know about asset allocation and diversification in retirement is wrong, because it is. Because if you're taking money from your portfolios and, you're doing this nice little, okay, I'm going to take 3, 4, 5% a year, assuming nothing happens in the market, or you have some ridiculous, retirement calculator that says you're going to average 5%. Well, what if the market goes down 30 or 40%? Well, guess what? That 5% is not going to work out anymore. So I care about you. I want you to be protected. Give me a call if you'd like to get a second opinion from me. Again, personally, David Reyes. Again, we'll do a second opinion. We'll look at your risk first. It's the most important. We want to reallocate assets today, right now, this second, not when the market rolls over. Let's be in a position of strength so we can make good decisions, not under duress. I'll do a fee analysis for you. Most of you own mutual funds. Mutual funds are very expensive. It's the worst asset to own. It's the most expensive. I can reduce your fees. Number 3, I'll do a complete retirement income plan, including Social Security, your 401ks, IRAs, all that kind of good stuff. Minimize your taxes, all for free. I don't charge to do that. If you'd like to take me up on that, give me a call, 1-800-611-1967. That's 1-800-611-1967, or go to reyesplan.com. That's REYES plan.com. Hang on, I'm going to talk to you about 3 reasons annuities are an unsung hero in retirement. This is a great article by Forbes magazine. So hang on, this is David Reyes, your retirement architect.